Put this in perspective for us. Should we be worried about DBS's capital outlook after these higher capital charges by MAS?
Thanks for having me, Haslinder. Now, we feel that the MAS higher capital charges for DBS after digital outages could reduce the bank's core equity tier 1 capital ratio by about 0.2%, and that brings up to about 14.1% based on the first quarter 2023 figures. Now, still, DBS had about 2 billion to 5.6 billion in Sing dollars of excess capital, given its target operating range of 12.5 to 13.5%, and we are still quite comfortable with the bank's capital.
So what does this mean for DBS's credit ratings? I mean, it has in recent years been regarded as being one of the world's safest banks and Southeast Asia's safest bank.
Yeah, Rich, I think that's a good question. And, DBS, solid capital reserves continue to be a credit strength, we believe, and that is unlikely to actually affect its robust credit ratings. We believe the bank's healthy earnings momentum this year, despite the macro headwinds that we see, are well able to actually meet its risk-weighted assets consumption this year, and the bank continues to be well capitalized.
And Rina, fair to assume that DBS has enough capital to support its higher capital charges this year?
Yeah, as mentioned, DBS earnings momentum, we are expecting the bank could continue to maintain a double-digit earnings growth versus its very modest risk-weighted assets growth this year, just given as loan growth continues to moderate for most of the lenders in this region with the macro headwinds. And that being said, DBS have ample capital reserves to support its growth as well as to buffer potential credit losses as macro headwinds escalate this year. Now, we continue to see DBS earnings to be really robust. That being said, DBS capital continues to be really solid, and they are unlikely to even come to the private market for capital bonds issuance this year as well after they come due.